If a major global war started tomorrow morning, most people would assume their biggest financial risk was the war itself. But history suggests something far more uncomfortable. The war is often not what destroys the average investor's portfolio. The real damage usually happens in the first 30 minutes after the headlines appear, when fear is highest, information is incomplete, and millions of people make the same decision at the same time. They do not call it panic. They call it being responsible. They call it protecting themselves. They call it waiting for clarity. But in real markets, that first wave of responsible behavior is often where years of compounding quietly die. In other words, if a global conflict began tomorrow, most investors would not lose the most money because missiles flew, oil spiked, or television anchors wore their serious faces. They would lose it because they opened an app, saw red, and sold good assets to buy emotional relief. That is the part almost nobody says out loud. Fear does not just make people emotional. Fear makes people feel rational. It creates the illusion of clarity. It makes a terrible decision feel disciplined. And that is why crises are so expensive for ordinary investors. While one group of people is panic selling at 6 in the morning, another group is quietly buying in a very specific order. Not because they are braver, not because they know the future, and not because they enjoy chaos, but because history has already shown what tends to happen to money during war, inflation shocks, and geopolitical panic. The order looks wrong at first. It feels almost backwards. But if you understand it, crises become manageable. If you do not, the next major shock could erase years of progress in a matter of weeks. Why panic becomes a product. Before we talk about a single asset, we need to talk about the machine that monetizes your fear. Because when geopolitical tension rises, the biggest winners in the first 24 hours are often not defense contractors, oil producers, or gold miners. The first winners are attention businesses. Financial media thrives on urgency. When the world feels unstable, ratings rise, engagement jumps, and advertising becomes more valuable. The longer people stay scared, the longer they watch, and the longer they watch, the more profitable every dramatic headline becomes. That does not mean every journalist is dishonest. It means the incentive structure favors drama over proportion. So when the market drops 2% after a war headline and the banner screams global markets in freefall, remember this: a 2% decline in the S&P 500 is not extraordinary. T. Morgan's market materials and long-run market history both reinforce a simple truth. Markets are volatile by nature and short, violent moves are common, but missing the rebound is often far more damaging than enduring the drop. Moderate pullback consistent with historical volatility does not make people click. Free fall does. Temporary repricing of geopolitical risk does not hold attention. Everything is changing forever does. And once the emotional temperature rises high enough, investors stop asking the only question that matters. Is the thing I'm about to do actually improving my long-term position? Or am I just buying a few minutes of psychological relief? The Mark and Sarah split. Imagine two investors with roughly the same life, the same savings habits, and the same starting portfolio. Mark and Sarah both have around $40,000 in broad index funds. Both contribute monthly. Both say they are long-term investors. Then a real geopolitical shock arrives. Russia invades Ukraine. The market opens lower. Oil surges. Social media is filled with maps, sirens, predictions, and clips of serious men explaining why this time is different. Mark watches 3 hours of coverage. He hears the same words on repeat: crisis, escalation, volatility, uncertainty. By 9 in the morning, he sells everything. It feels responsible. It feels like action. It feels like taking control before things get worse. Sarah sees the same headlines, but instead of marinating in commentary, she looks at what history and market research actually show. Reuters reported that on February 24th, 2022, the S&P 500, after falling sharply intraday on the invasion news, finished the day higher, a perfect illustration of how quickly markets can reprice once uncertainty starts narrowing. She also understands a deeper principle supported by long-run market data and widely cited work from JP Morgan. Some of the market's best days happen disturbingly close to the worst days, which means exiting during fear often guarantees missing the rebound. So Sarah does something that looks passive from the outside, but is actually highly intentional. She turns off the television, goes to work, leaves her automatic contributions running, and starts adding to her portfolio in a structured order. Everything that follows is the difference between reacting and executing. What history actually shows. The most uncomfortable truth in this whole topic is that markets do not necessarily behave the way morality, emotion, or common intuition expect them to behave during wars. That sounds cold, but it is important. War is a human catastrophe. It destroys lives, cities, and trust. But markets are not moral systems. Markets are pricing systems. And when governments mobilize, they spend aggressively on fuel, logistics, military equipment, communication systems, industrial output, transport networks, and medical infrastructure. CFA, Institute's historical review of U.S. capital market performance during periods of war, found that stocks often produced positive returns during major wartime stretches, and in several historical comparisons even showed lower volatility than long-run market averages. That does not mean war is good. It means broad capital markets often adapt much faster than frightened investors do. The investor who stays anchored to a rules-based plan is not denying reality. They are acknowledging that markets can remain investable even when headlines become frightening. This is where many people make the same expensive mistake. They think safety means cash. But in inflationary shocks, safety can become a slow leak. If prices rise while you wait to feel better, then your purchasing power keeps falling even while your stress remains high. That is how investors get trapped twice, first by fear, then by inflation. The smartest order to invest if a global war started tomorrow. The key is not to rush into random assets. The key is to build from stability outward. The order matters because each step protects your ability to survive the next step. Step 1. Build a cash safety floor, not a cash graveyard. The first move is not chasing upside. It is ensuring you do not become a forced seller later. Sarah keeps roughly 6 months of essential expenses in liquid savings, high-yield savings, money market exposure, and a modest amount of physical cash at home. The physical cash part sounds dramatic, until you remember that modern conflict includes cyber warfare, payment disruption, and temporary infrastructure outages. This is not apocalypse thinking. It is short-term liquidity thinking. But the line between safety floor and cash graveyard matters. Warren Buffett has long warned about the purchasing power risk of holding excessive cash, and wartime or conflict-driven inflation makes that risk worse. Once the emergency layer is covered, too much idle cash becomes a liability, not protection. Step 2. Gold as a diversifier, not a religion. Gold earns a place in the framework, but only if you understand why. The wrong reason to buy gold is because you have been hypnotized by fear and think civilization is ending. The better reason is because gold can serve as a non-correlated hedge when confidence in currencies, institutions, or geopolitical stability weakens. Timing matters, though. Gold often spikes when fear is already on the front page. Investors who buy only after panic peaks may be paying for a fear premium. That is why a modest strategic allocation makes more sense than a dramatic emotional one. World Gold Council data shows central banks bought more than 1,000 tons of gold in each of the last 3 years, including 1,045 tons in 2024, indicating that structural sovereign demand has become a serious long-term support under the market. That is a much stronger foundation than a retail panic thesis. Sarah uses a low-cost gold ETF for most of her exposure and keeps a very small physical allocation as a backup hedge against temporary digital disruption. Step 3. Defense, because governments do not bargain with geopolitics. Defense exposure is uncomfortable for some people emotionally, but from a market standpoint, it is one of the clearest channels through which wartime or pre-war tension turns into corporate revenue. When military budgets rise, contracts follow. When inventories need replenishing, order books thicken. When alliances rearm, procurement stretches across years, not days. Following Russia's invasion of Ukraine, Germany launched a landmark €100 billion special defense fund. and then went on to hit the NATO 2% GDP defense spending target in 2024 for the first time in decades. Reuters later reported that Germany is now planning materially higher defense spending, still underscoring that this is not just a one-quarter reaction. It is a structural shift. That is why Sarah adds diversified defense exposure rather than betting on one contractor. She is not trying to pick a heroic stock. She is aligning with the fiscal direction of governments under stress. Step 4. Energy, because conflict reprices supply faster than opinion. Energy is often the fastest bridge between geopolitical risk and market reality. Shipping routes matter. Sanctions matter. Pipelines matter. Choke points matter. When conflict threatens supply, oil and gas markets reprice immediately. During the 2022 Ukraine shock, Reuters and market performance data showed how quickly energy became one of the few clear winners, while broader equities struggled. In 2022, energy was the standout sector, while most of the market suffered, with XLE up sharply for the year, even as the broader S&P 500 fell. Multiple market summaries from that period show energy outperforming the index by a massive margin. Sarah does not need to predict exact oil prices. She only needs to understand the mechanism. When global conflict endangers supply, energy producers can become cash machines. Step 5. Consumer staples. The boring shield. In every crisis, there is a temptation to think the winning portfolio must look exciting. It usually does not. People cut vacations before they cut toothpaste. They delay luxury spending before they stop buying groceries, medicine, detergent, and basic household goods. That is why consumer staples matter. They are the financial equivalent of plain food in a storm. Rarely glamorous, often essential. Sarah adds staples not because she expects them to explode upward, but because she wants part of her portfolio tied to recurring demand that does not depend on optimism. In crisis investing, not everything should be designed to win hard. Some positions are there to keep you from bleeding badly, while other parts of the portfolio do the heavier lifting. Step 6. Inflation protection, because nominal safety can still be real losing. One of the great traps in conflict periods is assuming all government bonds are automatically safe. If inflation accelerates while governments borrow aggressively, traditional nominal bonds can lose real purchasing power. That is why inflation-linked instruments matter. Treasury Direct explains that TIPS pay interest on principal that adjusts with inflation, meaning their structure is specifically designed to preserve purchasing power more effectively when prices rise. In other words, if war or geopolitical escalation leads to higher inflation, nominal safety can quietly become real loss, while TIPS provide a more logically aligned hedge. Sarah uses that layer not because it is exciting, but because a good portfolio is not just about chasing upside. It is about not getting blindsided by the obvious second-order effect. The rule: most people break at exactly the wrong time. After building those layers, cash floor, gold, defense, energy, staples, inflation protection, Sarah does something that looks almost too simple. She leaves her index funds alone. No dramatic reshuffling, no full liquidation, no "I'll get back in later." She keeps broad market exposure intact and continues contributing automatically. This is the part many investors miss because it feels unsatisfying. But broad index funds represent the productive engine of the economy over time. And history keeps humiliating people who assume temporary chaos permanently breaks that engine. JP Morgan's long-run illustrations about missing the market's best days make the lesson brutally clear. Stepping aside at exactly the moment you feel smartest can cost you far more than the drawdown you were trying to avoid. The outcome that makes people angry. Mark sells $40,000 of index funds, sits in cash, watches the news, feels informed, and waits for clarity. But clarity arrives late. It always does. By the time he feels safe, some of the rebound is already gone. Inflation has chewed through the value of his cash, taxes may have been triggered, and the emotional damage is worse than the financial damage because now he has to admit he was not protecting himself. He was paying for the feeling of temporary certainty. Sarah experiences the same headlines, the same fear, and the same uncertainty. But because she had a structure, she does not need to invent a plan in the middle of a panic. She executes one. And over time, that difference compounds. Not because she found a magical stock, not because she predicted the next move perfectly, but because she avoided the first mistake, which is the one that usually makes all the later mistakes inevitable. The shock hook you should remember forever. If World War III started tomorrow, the most expensive mistake would probably not be failing to buy the perfect hedge. It would be selling the wrong assets in the first hour, and then spending the next year trying to buy your discipline back at higher prices. That is the sentence most people need to hear, because the modern investor is not usually destroyed by ignorance. They are destroyed by urgent half-knowledge delivered at the exact moment their emotions are least trustworthy. The goal in a crisis is not to become fearless. The goal is to become structured. Financial success during geopolitical chaos rarely comes from predicting world events better than everyone else. It comes from deciding in advance what you will not do under pressure. The person without a plan opens the app and sells everything. The person with a plan checks the framework they already built, leaves the core intact, and acts in a sequence that history actually supports. One of those people builds long-term wealth. The other unintentionally funds the attention machine that profits from their fear. If this changed how you think about money during global chaos, subscribe now. Because this channel is built for people who want financial clarity before the next headline hits, not after. And if you want to protect your portfolio instead of your ego, watch the next video. Because the first mistake investors make in a crisis is panic, but the second mistake is thinking cash alone will save them. Thanks for watching.